Welcome back to Market Mashup, presented as always by schaeffersresearch.com. I'm your host, Patrick Martin, coming to you live on a balmy 50-degree day here in Cincinnati, Ohio. Back like he never left, we've got Tony the Battista of tastytrade.com, a recurring guest and fan favorite. Tony, my man, it's good to see you. How are you?
Thank you. Always a pleasure, and congratulations on making it to the Super Bowl there. I got to give you a little bit of shout out.
Yeah, well, if you can see here, I figured I'd represent well. I've managed to wear a piece of gear every day this week, and I even started off on Sunday with a huge order of Skyline. So I'm doing every little juju, momentum, mojo booster I can. I will say the city's on cloud nine, so thank you.
I bet.
We'll get your prediction for the game at the end.
Oh no, I don't know if you're going to want to hear it.
Oof. No, it's okay. Hey, look, I'm a realist, so yep. I'm totally okay with that.
You're the hot hand, but we can talk about that later.
Yeah, that sounds good. Mm-hmm. It's always good to sit down with Tony as a sort of market reset. We've got a lot to talk about today. Earnings season is wrapping up. It's been a highly impactful one so far. You think of Meta platforms or Facebook, whatever the hell you want to call it, and the shitstorm that caused. Ford Motors gapped lower. That was kind of a random because everybody had been loving Ford Motors. And then you got tons and tons of winners, of course. Apple, Snap. The big one today was Enphase Energy. You can catch that on our website. That was a biggie. Yeah. What are some general tech takeaways that you've drawn from this latest earnings season?
Yeah, earnings seasons are a love-hate relationship with me, and I think for retail investors as a whole, when you've got a good bull market, which we've had in the past decade or so, earnings seem to be a love fest for everyone. I think this is the first time we had a little bit of a taste of what I think earnings are more like. I mean, they usually overperform because a company always talks about, and now listen, I'm a publicly traded company now with IG Group buying us, and when we were a publicly traded company with Thinkorswim, you don't want to come out and prior to earnings saying everything is amazing and your stock gets ahead of itself. You try to play it down a little bit and say hey, we're doing good, we're hitting all cylinders, and we like our projections. You don't really kind of go crazy. So earnings normally have a little bit of a bullish stance to them, but you did see some stocks get whacked this time, and they are unrelenting when they do that. And I think that's a little bit more of what we might see in the future for earnings. I think volatility was a little bit too low going into this quarter. And I think next quarter you'll see volatility for earnings a little bit higher and maybe a little bit better of a premium selling play. They have not been a good premium selling play this first quarter. And that's what I like to do, is sell premium. So earnings for me this first quarter was more like 2018 when we had a market that was a little bit softer than it had been in the past few years.
It's funny you mentioned the premium selling, because one of our internal metrics, Schaeffer's volatility scorecard, there have been a couple of stocks this past couple of weeks where their volatility score is low. And when that score is low, that indicates that the premium selling strategy is prudent. And that stands out because usually it's a little rare and it's been less common in the past year or so. And I'm with you there. I kind of see that becoming...
Volatility, market volatility as a whole, we're around 23 or 24 on /VX. That's the VIX futures. That's what I look at. Mm-hmm. Comparing it year over year, it's at the low end for the year. And I know the year is only a month or two away, but in a 6-month time frame or so than it had been the prior 6 months, it's actually higher than where it was. But I don't think it's reflecting the kind of volatility that we're seeing. I mean, you look at interest rates, the way interest rates are moving. It's just, I think we're in an inflection point, I think, with the market. I think it's actually behaving pretty good relative.
And for a lot of traders who are new to this as of 2020, this inflection point is something completely foreign. So they're going to have to be ready. This isn't just buy and hold or hop on Reddit and click a few buttons and you're there. You're going to have to think now. And
you're gonna have to think. You have to be a little bit more strategic. I think the V bottom is gone for a while. I think you'd have more of a. I don't want to call it a bear market because I don't think we're in a bear market, but I think you're gonna have more of a what I would say a normal market. A little give, little take, little give, little take, and hopefully we end up higher.
Yeah, I agree. Very well said. So on your site, tastytrade.com, by the way, all one word, you guys run a pretty cool feature trading concept. And I noticed your most recent one was about poor man's covered calls. So briefly, what can you tell a retail trader about this strategy and what sort of trading environment does it thrive in?
Sure. A poor man's covered call or a poor person's covered call, if we're going to be a little bit more politically correct, a poor trader's covered call.
There we go.
Arose by any other name, right? All it is truly synthetic stock. And there's many ways of synthetic stock. A naked put is a synthetic stock. Buy call, sell put on the same strike is synthetic stock. A poor man's covered call is a smaller way of using less buying power than the previous strategies I just mentioned a moment ago to use less buying power. You're basically buying an in the money option, 70, 75, maybe even 80 delta, depending on the stock price. If a stock is a very high price stock like the S&P, it's $400 or it's $300. That's harder to go deeper in the money like that. You're just paying a lot for the option. Not a lot of credit. It's just a lot for the option because the stock is so high. But you're buying an in the money option in a further out of the money, in a further out in time option, and selling one closer to the money in a closer month. Like for instance, now if I could just use a time frame, you might buy a June option with 120 some odd days away that's in the money, and sell an April option that's just out of the money with 64 days to go. It's a diagonal trade. It's a poor man's covered call, poor person's covered call. It's just a way of using a lot less buying power and having long delta. It's a long delta, positive theta decay trade, meaning you're getting paid to hold the position a little bit in positive theta decay. It's a defined risk trade. It's a high probability trade, and it's a relatively slow moving trade, similar to a covered call.
Well, when you say slow moving, that's exactly the sort of trading environment that we described, where it's not necessarily a bear market, it's more normal. And,
yes.
When you look at history, normal is slow moving. So I think this is something that's very pertinent to an investor right now. So I was doing some light stalking on you guys' Twitter page, and I saw a tweet last week that caught my eye. You guys had one of your live shows, and you asked, is it possible that the direction of the market over the course of the week can be determined by the directional move to start the week? So I want you to at least regurgitate that, and then I know you had some seasonality aspects you wanted to expand upon.
I do. Spoiler alert, it's pretty random. I know the CBOE has come out with weekly options now that will basically be daily. You'll have an expiration every day of the week in some small products, not small products, in a small subset of products like SPY, SPX, that kind of thing. So quickies, which is when we first invented them, what they were called, they're now weekly options. Probably a better name, a little bit more politically correct again.
That's the theme.
Yeah, totally. Retail investors have embraced it. Now, I don't know if it's the best place for all retail investors. I prefer you to take a little bit more time and be in monthly options just to give yourself some time to be right, be a little bit more strategic, like I just said, with a poor man's covered call. But, like a fly or a moth to a flame, we get dragged into this, instant gratification, instant pain type of thing. And we're always looking for a pattern on what's going on with the week. I mean, if it starts off bullish, will it end off bullish? It really is random. We've done a lot of research on it. We have not been able to find any patterns. There is some seasonality to it. During earnings season, maybe it's a little bit more bullish than other times, but it's way too random. And I think it's way too close of a look at it. The thing I've always heard in my 40 some odd years of trading is, the January effect, so goes January, so goes the market kind of thing. And we did another excellent, I think, research piece. And again, you take it for what it's worth. To me, it looks random. Maybe somebody else can see a pattern in it. If you look at, 2021, for instance, January was down 1%. For the year, we were up over 26%. You go to 2019, we were up 8% almost for the year. And we were up for January, we were up almost 29% for the year end. Go to 2016, and I'm just cherry picking ones because they're extreme. You go to 2016, the January effect, we were down 5% in January. We were up 9 or 9.5% at the year end. There really is no pattern in anything that you see here, whether it be a 1 week time frame or a monthly time frame.
And I also think, if you're doing so much digging and so much reshuffling of the stats and the dates and the time frames to fit a certain narrative, that's not helpful. You're just essentially asking for context, additional context. If you have to dig so much for something just to fit a narrative, then it's not going to work.
You make a great point there. You look close enough to something, you'll find what you're looking for. Like numbers are weird that way. You can give two people the same set of numbers and they draw two different conclusions from them. It's very hard to get granular like that. I think if retail investors, and I'm all about the retail investor, if they stick to picking a strategy that works for them, whether it's their risk tolerance, and I'm not talking about how much money they can make or lose, but how much money they have invested in that strategy, whether it be $100 or $1,000 compared to their own portfolio. Is it a small amount of money? If they stay small, trade a little more often, the numbers will work out. If you're doing a 50-50 shot on your weekly options, you know what? At the end, your results will be 50-50. You may make money or you may lose money, but your results, your win ratio will be 50-50. If you're picking out a strategy that has a 70% probability of success and you do enough of them, man, the math is so solid. You will have a 70% probability of success. You may not make any money or you may make a lot of money, but at least you'll know on entry what your success rate is going to be. And then manage your winners. It's like put greed away and manage your winners.
Yeah. Going back to what you were talking about, the seasonality, our quantitative analyst, Rocky White, put out an article yesterday, and he threw in something hokey like the Super Bowl indicator of how a Super Bowl team can indicate the direction of the market. And it was a very clever article. At the end, he goes, look, I did this as a point to show you that randomness is a thing. Sure. And even if you have seasonality that you really believe, it shouldn't be your sole measure. And like you said, you need to look at the numbers. You need to look at the probability. It should be a tool in your chest, not your defining feature.
Yes. Market Watch came out with a study. A lot of people sent it to me that they claimed was 100% accurate unless we were in a recession. Now, I don't know of any, I'm not an economics major or anything like that, but I know the only way you can tell you were in a recession is when you get out of a recession and then say that you were in a recession. So, here's an indicator that works unless we were in a recession, which we can't say when we were in a recession. And being in a recession is so, it's not quantifiable. You know what I mean? Like it's subjective.
Well, it's
so hard.
It's like dating. You only realize you're in a toxic relationship until you leave said toxic relationship.
Exactly. So, speaking from experience, I hope not, Patrick.
Nope, absolutely not. Nope, absolutely not. I just war stories I've heard from friends. So going back to your tweets, I see you do daily about ExDiv. And I think that's very important for a retail trader to understand. So can you break down what these numbers indicate and how they can take advantage of them?
Well, thank you for bringing it up. And I didn't know you were going to, but I appreciate it because not only ExDividend, Peloton, which does not pay a dividend, is a great example of what I'm trying to tweet out when I tweet out these things. Let me answer your question directly, and then I'll go to Peloton if I can. I'll make it very, very brief. I send out those ExDividends, which I get from Tastyworks, which is our brokerage firm, only as like a good to know. maybe you have a Disney, which has to have earnings today, but maybe you have a Disney position and it pays a decent sized dividend. It pays an 88-cent dividend. It's an $88 dividend on an option. If you have a deep in the money call spread, it could be 100% profitable. If you have that exposed option, somebody can exercise that option. You get assigned short stock, and all of a sudden you had this $1 or $5 wide call spread that you paid $3 or $4 for, and you were going to make $100, and now you owe an $88 dividend. You make nothing on a 100% winner for you. So I send out those things just so you can look at your own position. I know at Tastyworks, we send out email reminders to people who have positions and stocks that are going ex-dividend and just saying, hey, look at your position so you know what you have. But I don't know if all brokerage firms do that. I assume that the better ones do. So you should be looking at your own position, but it's just kind of a reminder. But Peloton was a great example of why you should know what you have on in your portfolio and close those trades before expiration. A little bit different than talking about ex-dividend, but work with me for a minute here, Patrick. Peloton was under $30. Let's say you had a short call spread and it was out of the money. It was 100% profitable on expiration Friday. And you decide not to close it because you don't want to pay the penny to close the spread or the penny to lift the short option that you have in exposure because you don't want to pay the commissions. Now, at Tastyworks, commissions to close an existing trade is zero. Mm-hmm. So it would have cost you nothing to close it. But other brokerage firms, they charge whatever, a price in, a price out, and you want to save the 50 cents or the $1 or $2, whatever it costs you for the trade. Well, as retail investors, we only have until about 3:30 or 4 o'clock in the afternoon to exercise an option if we wanted to. And if it's out of the money, it's not going to be an automatic exercise. Well, Peloton comes out with their news or whatever, Amazon or Nike or whatever the case may be, that they want to acquire Peloton or looking into Peloton. And all of a sudden, Peloton goes from under $30 to $35 overnight. And a market maker, and I was an ex-market maker, may have until 5 or 6 o'clock at night to exercise an option. All of a sudden, this short call spread that was 100% profit, you come in with short stock, and instead of making money, you actually lose money, and now you have to cover the stock on the opening. Even if you had an in-the-money call spread, maybe one strike in, one strike out, and you thought you were going to come in with long stock, you come in with no stock, and maybe you have an offsetting position against that. So closing your trades before expiration, I think is, you give up pennies 10 times, and you save yourself dollars one time when the unusual happens.
And I don't think it's super unusual what happened with Peloton. I mean those moves.
It happened in Amazon, I think, a few months prior to that, similar to that right at expiration.
So it's just something to keep in mind. Of you take your small penalty.
Take the risk off the table.
Right.
You talk about picking up pennies in front of a steamroller. Take the risk off the table. Use that buying power and money someplace else. You'll make the pennies back by just the amount of time you're putting in the new position. You'll be fine.
Just takes just calm. Just you're gonna be fine. Yep. Don't worry about the small things there.
Yep.
I love that. Okay, well let's pivot to some of the new stuff that you guys are working on over there at Tasty in the future. I mean, am I imagining things, or I was watching some show and you guys have ads on, I think, Hulu or YouTube TV now?
I think we even had a couple on some football games too.
Yeah, I did a double take. I was just sitting there on my phone and I hear Tasty Works. I'm like, wait, what?
Yeah, we even sponsor the Bulls, the Chicago Bulls now. Tasty Works has the name underneath the bench, and we're on the floor. They put a hologram for the TV broadcast in the middle of the court, which is kind of cool. Yeah, IG Group, which is a firm out of London, recently purchased Tasty Trade. Tasty Trade is the whole entity, Tasty Trade, Tasty Works, small exchange, all the different fingers and like Luckbox and other smaller companies we have. They bought everything. They've kept us all on. They've left us alone. They appreciate what we've built, and they had no. Well, I wouldn't say they had no. They had a smaller footprint in the U.S. and they're trying to make a much bigger footprint in the U.S. And they think Tasty Trade can bring them there, and I think we can too. So they've started to advertise. We have an advertising budget. It's not just Tom Sodnoff and Scott Sheridan and Christy Ross and the rest of us putting our money up to get our name out there. We now have a bigger war chest, and we're ready to go to war.
That's exciting, and I think they picked the right people.
Thanks.
So congratulations there.
Thank you.
Can't wait to see what's going on. Maybe they'll toss you some Bulls tickets, and
yeah, for sure.
They got a decent squad down there, so that'll be nice. Great. So I'm about to wrap up here. We danced around it in the beginning. Give it to me straight. Rams, Bengals. What's going to happen?
I think you know what I think. Wow, if the divisional games were any indication, you want to go with Paddens. If they're any indication of what the Super Bowl is going to be like, it's going to be a great Super Bowl, and that's what I'm hoping for. I want to see a great game. I know you're a Cincinnati fan, so you got a lot more skin in the game. I think the Rams are a little bit too complete of a team, but there's that untangible. You are the hot hand in Cincinnati. 4.5 points now if you're going with the spread, not just going with the heart where you want Cincinnati to outright win. 4.5 points might be enough in a close game, but if push came to shove, I'm going to go with the Rams. Give the 4.5 points. Sorry.
Totally get it. That's fine. I understand. And
I want your love. I'm not, as a Cincinnati fan, that's what you want to hear.
Yeah.
You want to be the underdog. You want to be the we can't win. The magic is, how long can it last? But man, you got a stud quarterback, and you're gonna be able to ride his back for years.
Yeah, I'm going with
hopefully.
The 4.5 I think is mostly because of McPherson and the weapon that he is. But I'm going 27-24. McPherson at the gun. They carry him off the field in SoFi. And we party on in Cincinnati. So
fair enough.
That's my thing. But hey, congrats on Lovie Smith partying like it's 2005 again, I guess.
Yep.
But no, that's really all I got. I appreciate you checking in with us, Tony.
Thank you, Patrick. Appreciate you letting me talk to your audience.
Good luck with everything going forward, and I'm sure we'll speak soon.
Thanks again, man. Appreciate it. Have a great year.
You too.